Tariffs and Tightropes: How Global and Local Issues Are Shaping GTA Real Estate in Spring 2025. That's the title I decided to give this episode of Building Wealth Through Real Estate, Brick by Brick. Simply because the overarching issues that are shaping our market, our real estate market, really have to do with tariffs and the balancing act that the local and federal governments need to do in order to counteract the effects of these tariffs. I want to start this episode by looking at the 7 factors that are affecting real estate values. We should always keep the 7 factors in mind when we consider what drives real estate values, because they really show us a clear picture of what's happening that is contributing to the changes in real estate values. There are 7 factors, as I mentioned. I will be highlighting 4 of those factors during this episode. The first factor is the cost of ownership. I made a slight change to that because really what we're dealing with are shelter costs. So it does involve ownership, obviously, but it also includes rent, because it obviously costs a certain amount of money to rent a property. So those costs are important to those that are in the rental space. So cost of ownership, cost of shelter. Job security is another extremely important factor as we look at what's happening in the economy, the global economy, as well as local. Supply as well. What is going on in terms of supply, what we are having in terms of inventory, what's available, and global factors. So they are playing a huge role in the environment, in the marketplace, and we will obviously be talking about global factors that are affecting real estate. My name is Nico James-Bock. I am a broker and CondoWiz in downtown Toronto. In this episode of Building Wealth Through Real Estate, we will look at the 4 of the 7 factors that are driving real estate, that contribute to the changes in real estate values. When we start talking about the changes in real estate values, I want to go back to February. The February 2025 Urbanation report highlighted that there was a mild price decline from previous months, the end of 2024 and into January 2025. So the February 2025 stats show really that we are still right where we should be when we look at overall value, over a longer period of time. So 10 years in this case, we're right really where we should be. If we go back to 2016, when the average selling price was $684,000, a little bit over $684,000, we look at the price appreciation throughout the years and what has happened that contributed to those price changes and price appreciation. We jumped to 2020 when we were at the start of the pandemic in March 2020. And we look from there that we see that prices have actually spiked and increased significantly from that point on. Then there was a sudden decline in overall prices, and that was in the end of 2022, beginning of 2023, when we had the change in the interest rate. So as soon as the interest rate went up, then we obviously saw, according to this chart, we saw that the prices took a hit. And real estate is very, very sensitive to changes in cost of ownership. So it's no surprise that as soon as the jump in the interest rate occurred, then we saw an immediate drop in prices. And that drop continued as the interest rate increased. Then it started to level off. As people got accustomed to the high interest rate environment. Last year, 2024, after 3.5 years of continuously increases in the interest rate, we had an interest rate drop. The first drop occurred in June 2024. We saw that the drop in the interest rate had not an immediate effect on prices, but we saw prices start to continue to level off, and we noticed that as the drop in interest rates continued, we noticed that prices started to rebound slowly. So there was not the rapid increase in appreciation. It was more measured. And that's where we find ourselves today, March 2025. Stats, which I will get into shortly, show that prices really have held up quite well. If we go to the supply issue, we see that when supply rises above 6 months of inventory, that's in the condo space, we see even in the condo area, prices are still quite steady. So throughout the increase in inventory, particularly in the condo sector, we noticed that prices were fairly stable throughout the increasing months of inventory. So in the other asset class, which is freehold, so detached, semi-detached, and freehold towns, and those inventory levels are much lower, but those prices are also holding steady. Market conditions are stronger in the 4016 and then as opposed to the 905. This again is according to the February 2025 Urbanation chart. Toronto is holding quite well. That's all of the districts, Toronto West, Central, and East, are showing quite healthy market conditions. The 905 regions, which we will take a look at in greater detail shortly, are experienced much more fluctuation in terms of value and in terms of months of inventory. So when we look at March, overall, rather than getting into the stats right immediately, we'll look at the overall issues facing the Canadian economy in March. These are reflections from Dr. Sherry Cooper from Dominion Lending Centers. She, as you know, is the authority on what's happening in the economy, the authoritative voice, and we look to her most frequently to get her take on it. Very few people actually say it better than Sherry. So, the Canadian job growth stalled in March 2025, with the economy shedding the most jobs in over 3 years, contrasting with strong US job growth during the same period. Job losses in Canada are partly attributed to trade exposed sectors influenced by US President Donald Trump's tariffs and Canada's retaliatory measures. Despite Canada dodging the latest round of tariffs, the previous levies have weighed on the job market. Jobs are being hard hit by the tariffs, as the costs of exporting and importing have affected many industries, creating a dilemma for the Bank of Canada regarding inflation and unemployment. Following the weak jobs data, stocks have significantly fallen and bonds have rallied, causing a drop in market-driven interest rates, increasing the likelihood of a Bank of Canada rate cut at their April 16th meeting. So the 1 second. The March inflation data, due the day before the Bank of Canada's meeting, will be crucial in their assessment of whether to cut rates to counter economic weakness or hold due to tariff-induced price pressures. Current market odds for a rate cut this month are at 33%, but a cut in June is anticipated if the economic slowdown persists. If we look specifically to the GTA real estate dynamic, we're looking at really two markets, as I mentioned in a previous podcast episode. We're looking at the condo market and the castle, or how I mentioned before, freehold market. So these are my insights as to the effects of the most recent changes, i.e., the tariffs that have been bandied about since Donald Trump's inauguration. So home ownership affordability in the GTA improved actually in March 2025 due to lower borrowing costs. So there were two interest rate cuts in 2025 already, and home prices compared to the previous year, with potential for further improvement due to anticipated interest rate cuts. So buyers have more options and negotiating power due to increased housing inventory in the GTA. So 6 months in the condo sector, between 3 and 4.5 months in the freehold sector, depending on the pocket that we're talking about, and we'll look at those pockets shortly. Despite improved affordability and inventory, GTA home sales decreased by 23.1%. And average selling prices fell by 2.5% year over year in March 2025, potentially due to economic uncertainty and the upcoming federal election. The condominium market in the GTA is softening. It continues to soften with declining sales and prices alongside a record number of new listings, creating opportunities in the resale and new construction market. While affordability is up and inventory is strong, sustained growth in home buying activity hinges on increased consumer confidence in the economy and job security, all of which are being affected by the uncertainty that has been created as a result of the ever-changing announcements from the US president. So if we look specifically at the GTA, we have obviously first the GTA overall market stats, and we see 4.68 months of inventory in the GTA. That's on average, though, because that also includes the condo and freehold sector. So that's an average. So it's considered high, but if you separate those, the freehold months of inventory is actually quite healthy. So the number of active listings, 23,462, is quite good. and normal. It's an increase of 88.88% year over year, which is actually quite good. 29 days of 29 average days on the market, which is also quite healthy. If we go to Toronto specifically, it is reflecting the average months of inventory at just under five. So all of that, or most of it, is in the condo sector, predictably. 31 days on average on the market, but only 9,000 average active listings, which is still a healthy increase over this time last year. Mississauga is also experiencing a fairly healthy market with 2,000 active listings, 4.46 months of inventory. The average price for a freehold property in Mississauga is $1,044,000, whereas the condo average price is hovering around $584,000. If we go to Brampton, Brampton is just slightly under $1 million in the average sale price, which is down from 2024, but that'll rebound quickly as we move further into the spring market, and it'll surely go over $1 million when we get the April stats. The condo sector is at 480,000. Brampton has 6.12 months of inventory. Again, that does include the condos, but it's still an extremely high number. So there's a lot of inventory, which is good for those looking to buy. So all of these the markets that are showing a high number of inventory, those are opportunities for buyers who are active in the market and not so much affected by what's happening in the job sector. If their jobs are fairly secure and not too hampered by what's happening with the tariffs, then they should be looking at those very, very sneaky opportunities that are in the market right now. Now, as I've mentioned, over the last, I guess, 4 months, is the opportune time to buy, especially if you're looking for a multi-unit community, so a condominium, cooperative, purpose-built rental building, leasehold. Any multi-unit community is showing a lot of opportunities because of the high number of units available. If we pass to Durham region typically has been hovering under $1 million for the past, up until now, basically. They have not breached the $1 million mark. So they're hovering around 903,000. Opportunities in Durham region abound. However, there are only 3.01 months of inventory in Durham region. So that makes it very challenging to find inventory, to find those opportunities. Savvy buyers who are paying attention to their equally savvy and informed agents will be able to take advantage of the opportunities that are existing in Durham region. Despite the relatively low inventory level. York region, which is a more expensive region overall. The average price is $1,226,843, which is down slightly, just slightly from last year. 29 days average on the market, so things are not staying on the market too long. 5.2 months of inventory. So there's more inventory in York region, more than in the GTA as a whole, more than in Toronto and Mississauga. In the condo market, average price for a condo in the York region is 660,000, which is a good number and staying fairly stable year over year. So that price really hasn't changed much from last year. And finally, the Oakville market. Oakville is one of the most expensive regions, average price being 1,439,719. That too is down very marginally, 4.6% over last year. So as I mentioned at the beginning of this episode, prices are holding fairly steady. 31 days on the market on average, 6.56 months of inventory. Lots of inventory in Oakville. Active listings at 1,174. So quite a good number of active listings, a good number of choice for people. But with that amount of inventory, there are a lot of opportunities in the Oakville market, if that's the market in which you have an interest. If we look at the continue to look at the dynamics, it's clear that business conditions have deteriorated due to the trade conflicts with the United States, okay, according to results from the Business Outlook Survey and the Business Leaders Pulse. Sales outlooks have softened, particularly for exporters, obviously because of the increased costs lobbied by the tariffs. Firms reported having sufficient capacity, and many are delaying investment and hiring decisions amid uncertainty, hence the rise in unemployment. So that's affecting employment levels, all of this uncertainty. Firms expect that widespread tariffs would raise costs and lead to higher selling prices. In this context, expectations for inflation are higher than they were last quarter. The next announcement for the Bank of Canada is April 16th. So if you look at the interest rate announcement schedule, we look back at the first announcement, which was on January the 29th. It was a rate reduction of 25 basis points, bringing it at that time to 3%. Then we had another rate reduction announcement on March the 12th, another 25 basis points, bringing the overnight lending rate down to 2.75%, where we're sitting now. So the next announcement on April 16th may be another rate cut. There will be another announcement. The next announcement following April 16th is June the 4th, where it's widely expected to be yet another rate cut. So we're anticipating in total 4 rate cuts up to June 14th for 2025. So if that holds true, then we should be down to 2.25% as the overnight lending rate at the June 4th announcement. So what's next? The federal election. So early voting will start on April 18th. That will continue until the 21st. So those can take advantage of early voting, and it's very important to vote. Take a look at what the leaders are proposing as various measures to help bolster the economy, help curb inflation, and counteract the effects of the tariffs. Easter is on the Sunday, April 20th. and the actual federal election will take place on the 28th. What are your feelings about what the leaders are currently saying as to what their plans are for the election? Do you think that they will be able to, which leader do you think would be more likely, a better deflector of the tariffs that are being lobbed? Which do you think will be the better leader to lead the Canada into a more prosperous and secure summer? So let me know in the comments, and then you can send me a DM. You can send me a direct mail, or send me a text message. That concludes this episode of Building Wealth Through Real Estate. Ciao, ciao.